does everybody want to just quickly introduce themselves?
Sure. Kinsey Cronin. I'm at Prime Trust, which is a trust company that custodies crypto assets for the trustee for over 24 stable coins, and we provide escrow services to new offerings, STOs.
Hi, I'm Ami Ben David. I'm the founder and managing partner of Spice VC. We're the first fully tokenized fund. We tokenized our fund earlier in the year, and we're actually investing in the security token ecosystem almost exclusively.
David Wield, Wield & Co., founder, chairman, and CEO. It's a network in the cloud, new model investment bank, grew 100% last year. We do token, we do capital raises for, can you not hear me? Huh, hold on. There we go. Is that better? Yeah, I think they must have just turned it on remotely. Wield & Co. network, new model investment bank, growing rapidly, doing token offerings, former vice chairman of the NASDAQ stock market, wrote the thought leadership that led to the Jobs Act. So people call me father of the Jobs Act. That gave birth to things like 506C and a lot of the capital formation legal structures that people are now using.
A tough act to follow. I'm Eli Blatt. I'm a Stanford PhD behavioral scientist. I'm a serial entrepreneur, and I'm the founder and CEO of BitFinance. And we are a robo-investment platform that makes it easy for investors of all classes, not just accredited investors, to build diversified portfolios of institutional-grade alternative investments in minutes.
Hi, my name is Alexander Dio. Professionally by trade, I'm a registered investment advisor. Presently, I'm a president and co-founder of Token IQ, and Token IQ's mission is to bridge the gap between antiquated legacy financial services and the new wave of blockchain DLT technology, and we're doing it by tokenizing securities and asset-backed contracts. Thank you.
Hi, I'm Aaron Tsai. I'm chairman and chief capitalist of Moss Capital and Moss Capital Universal Exchange. Since 1995, we advised over 30 companies in going public in the US via IPO and reverse merger. We launched our cryptocurrency exchange on August 1st this year, and we plan to launch an AI and blockchain-based decentralized exchange to trade securities, commodities, foreign exchange, and digital assets before end of this year.
Okay, terrific. And I'm Luke Kerner, and I'm a founding partner of Crypto Oracle, and we are a community first VC. Let's start off. So we got a lot of folks here. We'll start off, Aaron, with you on that end, and in a couple sentences, real quick, what would you, when you're talking about security tokens, you're trying to get people to buy security tokens, to tokenize their assets. What do you say? A couple sentences.
You say,
if you're trying to convince somebody, somebody's got an asset, somebody has a piece of real estate or some other asset that you think should be tokenized, what do you say to them to try and convince them that the right thing for them to do, rather than issue equity or issue debt, they should tokenize, they should do an STO?
Well, to do the STO would be easy to give them access to the worldwide investors right away, rather than go through the regulations in a traditional going public process.
Yeah. Alexander?
That's interesting. In our world is, I think, to put simply, there's no difference between the traditional way of doing fundraising with how security tokens can do this in this spectrum. So what you take is the analog version of securities, and you put them on a digitized formats of securities. To me, that's STO.
Okay.
Okay, well, the lack of operating security token exchanges notwithstanding, the prime benefit of
Other than that, Ms. Lincoln, really?
Yeah, really. The prime benefit, which is a temporary situation, right? NASDAQ just announced they'll have one, T0 will be online. I mean, there's several security token exchanges here. But the primary value of tokenizing an asset is making it more liquid. And historically, when assets are more liquid and also when they are more divisible, value goes up. So, there are obvious examples. If you're working with an estate planner, they'll tell you, oh, well, take this building and give a couple of % of it to your child, because then the asset is not wholly owned by one. It makes it less liquid. The IRS will lower its valuation. So there's a lot of both legal and empirical evidence for the fact that increasing the liquidity and the divisibility of something increases the overall value of that asset. So I think that's pretty compelling.
Any sense of how much?
I think the IRS will tell you about 30% is what your estate planner will tell you.
Okay, it's a good number. David, how would you answer the question?
Yeah, I think the liquidity issue is probably the key issue. But I think people have a perception that liquidity is sort of continuous trading, and that's really not what happens in private markets and microcap markets. In fact, that's very dangerous if stocks or tokens trade away and trade down, and it screws up your ability to do the B round pricing, the C round pricing, so on and so forth. So, but I think that where it's really going to help is if you're putting processes in place that take care of a lot of the constipation, the legal constipation of being able to transact in private markets, which is highly regulated. And I think that's a very interesting application for the technology.
Yeah, I mean, we're looking usually at three things. The first is the tradability, the practical ability to transfer value between owners. In many asset classes, it would require, all these transfers are local, hyper-local even, will require a lawyer, can take months, and tokens just turn all of this into a single instantaneous transaction that can happen worldwide, globally, 24/7. So that's the underlying thing. You're taking something that was 3 months with a lawyer, turn it into 1 second with a push button. So in itself, that's great. The second layer is to start adding the regulations on top of that so that you can actually start trading internationally and so on. And there, when we're talking about liquidity, I look at it as what I would call a liquidity spectrum. Before tokenization, you'd had liquid assets and practically the rest of the world, which is not public, maybe 90% of the assets of the world which were not public, had effectively zero liquidity. Now, when you add tokenization, you don't suddenly make everything public, but you create a spectrum where some assets can trade more, some assets can trade less. Our example, we are a tokenized fund. In a VC fund, when you invest in a traditional VC fund, you're practically, and for all intended purpose, locked for 7 years. And we're a fund as well, and whoever bought our tokens will get exit revenues in the same way that a regular LP will get in a regular fund. The only difference is that they're not locked for 7 years. So what is the added value in something that isn't locked?
The elevator pitch is going a little long.
Yeah, that's it.
I liked it, though.
Yes, it was good.
I think that there's been a lot of really smart comments in the panel so far. The part that I'll focus on that I think is transformational is the transparency. So hopefully, there's probably some people in this room that didn't understand everything that's been said so far, because our current system can be pretty jumbled and complicated. And obviously, there's the private side. But when it comes to initial offerings, giving more access and more information and requiring less people in the middle and simplifying, I hope that's what we're going to see out of STOs, is mostly just a sort of a recreation of the markets that we have that are regulated, but in a way that is taking advantage of the technology so that it's just a lot simpler, so that it's easier to understand where your money is going, even if it's on the private side, that you don't need to always leave everything entirely up to your managers. You should work with experts, but being able to see what they're doing is going to be really powerful for people who are making decisions about where their money goes.
Okay, cool. Thanks, Kinsey. So, Eli, you mentioned about the exchanges and how they're functioning now. Do you have any sense on the timing on, there are obviously a lot of great companies, a lot of them here, on when it'll actually be functional?
Yeah, I mean, I don't have any insider information. Nobody grab your phones just yet. But we are working with the attorney, Dan Viola, shout out to Sadis and Goldberg, who did the PPM for T0. And I have my understanding is that their tokens will be liquid mid-January. There's also another token exchange platform here that expects to go live within the next couple months. My gut sense from the basic temperature reading I'm getting is that by the middle of 2019, we may see as many as half a dozen exchanges and some additional meaningful trading velocity to be happening. But I also think that before then, you're going to see opportunity because it's clear that the market has shifted towards being a bit fearful, whereas it was very greedy previously. And as Warren Buffett obviously said, when others are fearful, you should be greedy. And I think a lot of I'm banking on the fact, as a startup that's doing an STO, I'm banking on the fact that a lot of the high net worth investors, the more savvy funds, the family offices that were fearful when everyone else was greedy, are now going to be seeing opportunity in this market and getting in early to some of the better security token offerings, and that represents a good opportunity for us.
And so if we're thinking about exchanges, David mentioned that the NASDAQ announced that they're going to be trading at some point. Do you think, David, that they're going to be able to be major players in this market, or do you think they'll be the major players in the market?
Well, I think that they've got the growth, the reputation, and the brand, and it's a hard lead for anybody else to surpass. So I think that whether they get there by internal development or through acquisition, my guess is that the incumbent players will ultimately emerge as the dominant players. NASDAQ and the New York Stock Exchange both own, I think, at least 3 self-regulatory organizations, which is a stock exchange technically, right? And I think there's 12 licenses out there, and what?
No, go ahead.
And I think that the 3 major players own most of them.
And so it's funny, right? When something comes in, you don't know whether the incumbents are gonna win, or in the early days, let's say, of when they opened up and they said, hey, you don't have to pay full fees anymore on the stock exchange. The brokerage, that's where Charles Schwab was born and became massive, and everybody else eventually ended up cutting price, but they never quite, but Charles Schwab today still in E-Trade, have significantly larger market shares of that market. So Ami, do you have, as you're thinking about the timing, and you guys are actually trading now on, or close, when you talk about where your platform is?
It's one of those things when I've been talking to exchanges and ATSs, and they've been promising me that next week.
Yep.
Next week. I've heard next week 9 times already. So, but in the end, it will be next week at some point. So I'm thinking over the next over the next 3 months, I'm seeing it happening. And one of the reasons that it's happening is we're actually one of our portfolio company launched a protocol, and we're actually integrating the protocol into these exchanges so that they can actually do it with our tokens. And once that's done, the technical side is finished, and so we're actually very close to seeing those come alive. But I agree that the big players, NASDAQ and so on, have a lead on the exchange side in terms of volume. The one thing that I would say is that it's not going to be the same thing. They will have to change their, the brand is there, but the user experience is going to be very different, because security token is going to be one long tail, a very long tail. It's not going to be a Netflix, it's going to be a YouTube. So, if you're built to do a Netflix type of, NASDAQ, your infrastructure needs to maybe look at it slightly different in terms of user experience.
What's the name of the protocol?
DS protocol.
Okay, cool. And Aaron, what's going on in
Well, I will have to disagree, because the history of cryptocurrency exchange in the 1.0 era already demonstrate to us that the business model and technology leads regulations, especially in Asia, which means unregulated security token exchange will likely to emerge as the future market leaders, just like the success achieved by illegal, unlicensed Chinese cryptocurrency exchange that dominate the world cryptocurrency trading today.
And so what about your platform do you think is going to have everybody come home, make it be the largest?
Well, our Mass Capital Universal Exchange target markets include companies and investors from both the emerging and underdeveloped countries. On our security token listing board, we will adopt AI based continuous due diligence on companies with monthly reporting standards. Cloud-based internal control and accounting systems are deployed to transform the security and commodity listing industry to a higher standard than NYSE and NASDAQ.
Okay, cool. Alex, you want to?
I really like it. It's like almost you have a scripted version of a panel. Man, this is amazing. So that's like a full-on compliance here, right?
Yeah.
You can't say left, you can't say right, it's just direct. Okay, awesome. Well, to be honest, I don't really need to say much about exchanges. It will happen one day. It will be one part of this ecosystem where everybody participate. And whether we need to strive for liquidity now or not, to me, it's going to hurt the market, the private market specifically. Because
I'm sorry, what will hurt the market?
Private.
You said it will hurt the market. What
will hurt private capital if the liquidity is available right there, right now. Why? Because traditionally companies are built on the premise of accepting the funds, building the company, at the right time you IPO. There is a reason why there are steps. And I may disagree with some of folks here, but the liquidity is not the goal for a startup company. For the startup company, it should be building the company, have the presence, have actual product in place, and then potentially think of the liquidity, because traditionally that's how founders actually get paid.
Right,
So,
that is traditional.
Just to make an additional point here is that liquidity is certainly important, but it's not now, at least to us. So what's important is to create the infrastructure for the user experience as well as bring all parties in one place so that the transaction itself can be done smoothly, can be done fully transparently, and every player would know exactly what to expect at any given time. So that one day, those that hold those tokens will know that, well, if they're exchanges, great, so we'll just exchange them. But the belief in the company, I believe that's why people would invest in the company, not just for the fact of, oh, one day I can just exit 10x, and by the way, this is just next month because the liquidity is available. There's no value that these supporters would follow, but rather have desire to liquidate and just have this arbitrage in place. So.
Well, look, I mean, you bring up an interesting point to the degree that you talked about how things work traditionally, right? Traditionally, you'd raise a little bit of money, you'd bootstrap, you'd get your mom and dad maybe to give you some money or a cousin or whatever, and then you'd build, and as you talked about. Now the question is do we think that things have actually changed? That now, because you can go and you can access capital globally in an instant, that there will be a market for companies who just have an idea to go out and raise large sums of money off of that idea. We obviously saw that during the bubble. Is that something that's gone forever? Is that something that comes back? Just because that wasn't the way the world worked, it doesn't mean that that's the way that the world should work. Do you think that companies should have access, and do you think that investors should be putting money into companies right away?
Ooh, that's something that the Jobs Act does allow for, that you can speak to, that if you are at least being transparent about the fact that you're just an idea, and you file properly and you pass your background checks and you do everything in a regulated fashion, there is room for that. There's room for companies to be raising capital without having an established business or revenues coming in. That said, we're going to see how the market actually responds to that, right? So what's really important is that there is regulation in place so that there's not the opportunity to mislead investors and give them the impression that there's been more done than there hasn't. So if there hasn't been even a prototype on something and it's just an idea and it's visuals representing what will be rather than what is, that's got to be something that's made really clear, in my opinion. And that's built into many of the regulations, and I think we'll probably see some evolution there as we learn from successes and from mistakes.
Okay, I know.
I really disagree with what you said about the companies. I mean, you're talking about the current situation where there's a dial and the company is either 100% liquid or 100% non-liquid. And in a situation like this, you don't want liquidity in the company too early because you think you want them to build a product and so on, but that's not going to be the situation. The situation is going to be a dial. You can actually decide how much liquidity you give. So the simple example I'll give you is companies. I mean, I started companies in the past. When you are a startup entrepreneur founder, you start your company, it's a 7-year gamble. You're going to work hard, you're not going to get salary for a period of time, and in the end of the 7 years, maybe you will get success, or more likely you will get failure. There's nothing in the middle, okay? Now, and it's the same thing for employees that get options. They get stock options. The stock options are useless unless they wait until the end and they get them. So I think that having the option to have a liquidity, you can say something like a founder can actually have some liquidity after 2 years, after 3 years, or after 4 years, and employees can have some liquidity, not full liquidity, 70% of their stock they have to keep. So there's going to be all sorts of new models. And one thing I learned about doing security tokens for the last year is that we all expect everything to be the same, just digitized, and it's not. Because it's digitized, it becomes different. And new models arrive.
Just to, are you talking to me or are you
About the
disagreeing
message that
with
you
me?
said
Okay.
earlier about the...
All right. Yeah, I was not clear, so.
Yeah.
I'm not saying it's bad. I'm just saying that it will happen one way or
It will
another.
happen.
And just to turn this faucet on or off, just a little bit here or a little bit there, is just the preference of the founders.
Mm-hmm.
I think the key word is evolution. I'm not saying that, oh, we have to follow what we presently have. I'm just saying that it will take some time. We can't just simply say, oh, we don't need lawyers anymore. We can just embed everything in these tokens, and all of a sudden I can do the cross-border transactions. By the way, we're dealing with the feds, we're dealing with the state, we're dealing with locals, municipalities, and every state has different rules. You can't just simply bypass and say, oh, all of this is
I
void.
don't think anybody's suggesting that we bypass the rules. I think the question was more one of just, you know,
Well,
should-
but there was an earlier comment saying, oh, there's a new generation of these SDOs where we don't need to spend 3 months on drafting the documents. I disagree on that because the legal framework still has to be there.
But you have to do it once. You do it once in the beginning, and then the tokens can trade. In the current situation, you have to do the 3
Well,
months
I'm not in
every time.
disagreement there, so it's like SAFT or SAFE, whatever the case may be, so you can still utilize this, but the custom made of those agreements still would take some time. So I don't know, we have maybe a lawyer.
Well, you're
Serrano.
not changing the regulatory framework.
Yeah,
You're
you
going to have to
can't, so-
report
Yeah,
on a
absolutely
quarterly
not.
basis if you're publicly traded anyway.
Yep.
Exactly. I think probably everybody on this panel is in agreement that regulations, whether you like them or not, are a thing, and if you're going to be a business, you got to follow
Yeah,
them,
and
right? I
if you,
assume
if
we're all
you
we're all
think
in agreement on
differently,
that.
so they're going to come after you. So this is what happens with ICOs. All of a sudden they think that, hey,
yeah,
we can
but
do whatever.
With the security token offering, which is what this panel is about. Let's just change the topic real quick. We were talking about founder liquidity before for a while. Yeah. Obviously, a big issue coming, a big issue. So even if you get public, what difference? Even if you do a security token offering, and now your token is in the hands of your investors, what difference does it make if they can't get liquidity for it? And Eli, how are you
Yeah,
thinking?
so I think we're actually asking the wrong question here. The issue for me is
Okay.
not founder
I won't
liquidity.
take that personally.
Well, or it's a conflation of terms, right? The issue for me, and I'm in the literal situation of trying to raise money and having both equity and security tokens, is investor liquidity, not founder liquidity, right? And I think you've got basically an environment where there's two classes of investors. You've got the ICO investors who were used to very rapid liquidity, high multiples, and sort of a freewheeling environment. And then you have institutional investors who are used to the 7-year exit, the long game, and we're now in an environment where the ICO investors are not sure about time horizons on liquidity and how security tokens will behave relative to what they've expected and come to know how to trade utility tokens. And the institutional investors have, for the most part, never purchased tokens and are also looking at the fact that there is, as a practical matter, no liquidity right now. And so eventually something's got to give and they'll have to meet in the middle. And then another point that I want to make that I think...
Well, do you have a sense of where is the liquidity going to come from?
It's going to come from the security token exchanges. and everyone's waiting to see.
Well, but there's got to be a buyer at the
Well,
exchange.
that's right. I mean, look, from a market structure standpoint, you got two types of security tokens, two types of securities. You got what academics call network effect, lots of buyers and sellers, just let the order book interact. That's the small minority of applications for what we're talking about, because there's massive numbers of smaller companies that are asymmetrical order book securities or tokens, big seller, no buyer. And the only way you're going to create a buyer is if there's economic incentives in the aftermarket and research and a point of view to get on the phone to go and sell the fundamental story to somebody on the other side.
Well, but again, you're talking about, and I obviously understand exactly what you're saying, but what you're talking about is how the world used to work. And the question is now, with all of these new technologies, are there going to be new ways of doing things? Are there going to be new ways of driving liquidity?
It's up to the regulators to decide whether or not they're going to allow an incentive, sort of a fixed, a higher spread, something to get the intermediaries back into the business to make markets in asymmetrical tokens. And there's a lot of legislation right now. There's the Jobs Act 3.0 that just went through the House, 410-4, includes a new form of exchange called venture exchanges, which essentially rescinds a lot of the rules that created this collapse in trading spreads and commissions in markets.
Right. And certainly, look, everything you're saying, you're obviously a world's expert on this stuff. But the question is now with these new technologies, right, is it possible to do different things? Ami, I know you're familiar with Bancor, let's say, and how they're trying to bring liquidity to the market. I'm not saying that's the answer, but that's innovation that you're able to get now with these new technologies.
Yeah, you were talking about the guy picking up the phone, calling somebody else, and doing a sale. And I see where you're coming from and talking about the new world. In a new world where these things are discoverable globally, and you can go into the right aggregators of this information. And if you want to, let's say, get a piece of real estate in the US, you could be living in Geneva, and you can go, nobody's going to pick up the phone to anybody. It's going to be a discovery mechanism where people will discover what they're looking for, and the winners will be those that will expose it properly.
And that's going to work for things with, yield, like real estate assets. Not going to work for equity, equity-related risks, corporate tokens. It's a disaster for them. We've seen it in microcap markets, in the stock markets already. It just doesn't work. You need somebody, if there's a story starts, a life sciences company with a token, somebody has to get on the phone and tell somebody why it's an interesting situation and tell them prospectively where the value is, because we've now all of a sudden got a big seller that's coming into the market, and somebody's got to go and create an offsetting buyer. Otherwise, what happens? The value goes down in the marketplace. And so this notion of, people are going to consume information organically instead of for microcap securities is just completely, in my view,
I think
fallacious.
People said that about, if you look at other industries, people said that about YouTube. People thought that, whoa, it's not going to happen, never going to happen. And in reality, a long tail has created. And I think that what we're going to see is a new level of very, very long tail, where parts of the tail are exactly as you described them. There has to be an actual sale. Part of the tail is going to be self-discovery, and part of the tail is actually going to be automatic, like you mentioned Bancor earlier, where there's actually, the trade itself is facilitated by having a relay that holds the tokens, waiting for a second price to arrive.
There's a long tail of over-the-counter stocks. There's 14,000 of them. They trade horrifically.
I know,
they
because
do,
I as a regular Joe from the street, I have no idea how to get there, how to touch it. I don't know where they are. It's not a mass market story, whereas the whole idea of creating the blockchain and the internet of value is to create a situation where there is a user experience for this long tail. Now, I'm not saying it's going to happen immediately. It will take years and years.
There's so much information on microcap, on these tiny little stocks. I can look any of them up by symbol or by name and get their financial statements online. There's information. The question is, does that information translate into a compelling reason to write a check to purchase something?
Sure. Look, undoubtedly, again, you're right. I think that what it comes back to, and interesting, Alex, you want to answer this? What it feels like to me, we are at in the stage, and we're at the very, very beginning of this whole brand new industry. And so far, yesterday we actually had a whole day, a security token day at a track upstairs, and we talked to a company, Aspen, that had tokenized part of a hotel in Aspen. It was very successful, and it was, the guy who was doing it, Stefan. He was very excited about what he did, and it was great. I was excited for him. That said, I really felt like, we have this brand new medium with all of these new tools, and it's like the beginning days of television. The very first television show that was ever shown was, NBC televised a guy sitting at a desk with a microphone going, "Hey, now we're on television." Right? Because they were just doing radio on television, so they were just porting over the old thing into the new thing. And the question is the new thing going to fundamentally change what a security is? Is it going to be able to solve for problems like liquidity, or are we just going to have a whole bunch of dead tokens out there?
Well, I think there's been a bit of a conflation of terms that's permeated this discussion, and I think permeates a lot of the discussion. We're like basically having a conversation about asset tokens. But the topic of the panel is security tokens. And we're in this unfortunate linguistic situation where all of our modifier words for the word token come before the word token. And so like people seem to think that utility token and security token are a dichotomy and something is one or the other. Security token really refers to the regulatory status of a token, whereas utility, asset, or payment modifiers refer to the function of a token, and they have totally different tokenomic models. And the only difference is whether or not they are regulated as securities. And the SEC chairman has said every ICO I've seen is a security, and we're just coming out of an environment where, and this is why there's 70 subpoenas issued, mostly against the Marco Santori SAF that was used by Cooley, which is a fine instrument, but the contracts to sell those tokens and the tokens themselves were ostensibly treated in those contexts as though they were not securities because they had a utility. Whereas in the United States, all of these tokens, by virtue of the investor's expectation of gain, fail the Howey test. And so I think it's important in these conversations to distinguish between, and I think the FINMA guidelines, the Swiss regulatory body, has done a really good job of laying out utility tokens, asset tokens, and payment tokens, and clarifying that any of those tokens can be a hybrid token, whereas it could be a utility security token, right? All asset tokens are securities by definition. So we're having this whole conversation where we're basically talking about tokenized shareholder equity and neglecting the fact that there's still a lot of access tokens out there, tokens that grant access to a network, et cetera, that are going to be securities. They're going to be sold as STOs, and they have nothing to do with corporate valuation or information relating to the balance sheet of a company.
That was the whole point of the question, actually, right? The question is, right, even the other things that you mentioned are the ways that securities were, right? So the question is, and I get, obviously everything you said was correct. And I'm not that deep on exactly how the Swiss have defined them, but my guess is that we're going to get a lot of different definitions across a lot of different jurisdictions. But what I'm interested in, whether Eli you want to continue talking or other people want to do it, but is if the panelists actually think that with these tools now we're going to be able to securities are going to be different, right? Because now all of a sudden we have the ability with a smart contract on top of the digital security for these things to be anything.
But they are different already. We're seeing this. I can tell you about a project where the token is going to be a security, which will give partial equity, some revenue share, and will also be used as a utility. Okay, and the reason they're able to do this is they're actually filing for an F1, which will allow their security to be traded publicly. Now, once they have a security that's trading publicly, they can start using it as almost a utility for their exchange. So like think about it as a regulated version of Binance. So I'm seeing all kinds of new models, and especially in the connection between, you talked about equity, there's debt, there's derivatives. I'm seeing now all sorts of companies trying to build new models that fit their specific situation. So if, for example, you have a company that's very profitable, they expect to be profitable, they can do a deal where you get tokens, and the token give you a lower portion of the equity, but if some terms are reached, like a certain profitability, they give you 10% of their top line revenues. Even T0 did something like that. All of these new models were not in existence before. They just couldn't be managed.
Now, Ami, I have a question for you then. How is this model handling the compliance requirements? Because moving a token that has no security attached to it from one person to another is not a problem. If there's a security, then you're running into some regulatory guidelines of the review of the ownership, because you can't be shifting the ownership of a security into the hands of anybody. You have to know who that person is.
So I think that what we're trying to build in security tokens is we're trying to go beyond security enforcement. We're beyond security compliant. We're trying to go to security enforcement, which means that in the code of the security token, okay, it is coded for the regulation that it's in. So if we have a Reg D security on a security token, the smart code contract will block you if you try to do a transfer that is not allowed by Reg D. This specific example that I gave before, they're doing Reg F, which is the equivalent of Reg S for foreign companies. So their security token will allow it. So you create a situation where actually the SEC should be very happy, because today the SEC relies on companies to follow the rules and the regulations. In the security token world, in the future security token world, you won't be able to break the law even if you want, because security token code will prevent you from doing so.
But does that mean then that you have to get identifying information from every
Absolutely.
person that
That's part of
gets
the
it?
token.
So that means that the utility of the token is limited to a use that's going to be allowing that kind of review, right? So otherwise,
If-
But if the application layer, navigates that for you automatically, then you essentially have smart trading in private markets. So in one jurisdiction, it will freeze it, and you can't trade it for 6 months, say, if it's under Reg D. But if you move into a European jurisdiction, you may be able to trade it, and ultimately you'll have authentication of accredited investors in accredited investor markets so that they can go through rather seamlessly. So I think that that's kind of the beauty, is that a lot of that constipation, because of the intense nature of all the different legal frameworks, ultimately should largely go away. But then the fundamental question of whether or not something is an asymmetrical order book security, meaning it's not innately liquid, you still have to create buyers to offset sellers. And if you go back and you look, Barry, everything most people know, Barry Silbert, who runs Digital Currency Fund, but he started a company. His first company was Second Market, and I was an advisor there. And one of the things that they learned trading unicorns was that companies did not want to see their stocks get traded at prices which were complicating their ability to do A, B, C, D rounds and manicure the pricing. So it moved from a model where they were putting up trades to one where where issuers were controlling the trading more like a call market, which is that they would do it periodically at their own whim, at their own price, and they would put an open tender out to their employees. And they'd say, okay, we'll take up to $30 million worth of securities at this price. People would tender. If less than 30 million came in, everybody got a fill. If more than 30 million came in, everybody got prorated. And that was the way that market started to evolve.
But it evolved that way because you had a market that was largely controlled by VCs who didn't want the trading of this. They were locked, they didn't want Facebook shares to be traded around. They wanted to be the person buying the shares if they were going to be traded.
Yeah, David Sachs had a very interesting quote about this when he said, look, you can agree or not agree with the, I'm paraphrasing, you can agree or not agree with the concept of liquidity, but if you have a situation where initially 10% of the market is liquid and 90% is not liquid, you're fine. But the more the market becomes more liquid, those that are not liquid have a hard time explaining to their owners why they're not liquid when the next company, which is exactly identical to them, is liquid, right? Because if you have two options, you can get an asset that's liquid immediately or an asset that will be liquid in 10 years from now. Obviously, we'll go to this one. So competition will create a situation, where it's just not tenable anymore to sustain a non-liquid scenario.
Maybe not, but I mean, in Europe, we've had public markets for years, and lots of family-owned businesses have stayed private, and there are lots of businesses in the United States that have stayed private. I mean, for me, I would reframe it a little, the question a little bit. It's an access to capital issue, and it's an access to capital at a price. And I don't need to be liquid for the sake of being liquid.
I need to improve my access to capital. And if this technology makes it easier because more investors come into the market, then it will be very attractive to people to leverage. They may not want to see aftermarket trading the way that Barry Silber and Second Market didn't, with that migration and the unicorns.
Yep.
But it's an access to capital question.
Maybe the question is with
Undoubtedly.
you.
Ami, unfortunately, our time is up. Let's give the panelists a big hand.
Thank you.